Hi, everyone. Great to have you here for today's Lunch and Learn session, where we'll be talking about building wealth for future success. If this is your first time joining an Enable Me webinar, welcome. If this isn't your first rodeo, welcome back. Just starting with a little bit of housekeeping here. If you do have any Q&A that you want to pop in, you've got a chat box and a Q&A box at the bottom that you can leave those in, and my producer will collate those as we're going. We obviously received a great number of questions in the lead up for today. We'll try to get through as many of those as we can at the end of today's session. And just lastly, today's session is recorded. Okay, so if we're all busy, if you do have to jump off at any moment, or if you missed the start or anything like that, don't worry, you will get a recording sent out to you in the coming days. So to start with, we're going to talk about what we're going to cover off in today's session. First off, one of the most important things is, why do we want to grow wealth? Understanding what that actually means, because it is a lot to do with more than just the money, more than a Rolex or a private jet or an island or anything like that. It's about the freedom and security that money and wealth can give you the options to do so. We'll break down some common misconceptions that many people have that are holding them back. We'll understand your personal wealth timeline and why that's important to the wealth strategy that you're creating. Why a plan needs to fit your goals and not just copying the person down the street or an article you might have read about. Understanding that balance between risk and reward. It's really, really important with wealth building, is understanding risk and reward and how you might have to take a little bit more on than you may have thought or may not need to. It can balance out both ways. We also need to understand that plans adjust as life changes. Okay, any good plan can't be static. And we'll wrap it up with some key takeaways at the end and Q&A to finish up with if we get through it all in time. Okay. Before we get into that, obviously, we've got to cover off this quick little disclaimer here. Today's session's for informational purposes only. How can it be personalized financial advice? I can't actually see you on the other side of this Zoom call. So it is informational. If you are looking to get tailored advice and understand your own unique situation, it is important to seek professional advice and book in with an advisor to tailor your situation. So first off, why would you be listening to me and when I'm talking about wealth creation and finances? So a bit of my background here. I'm a financial advisor and strategic advisor at Enable Me, and I've been with the company now for about 4 years. And for 10 plus years prior to that, I've a background in finance and consulting and business ownership, where I've always been involved in the numbers of helping businesses grow and realize their full potential. And now I'm helping individuals, mum and dads, retirees, make the most out of their situation. Okay. And as you can probably pick up from my accent, I am from Australia, come from Melbourne. It's probably ingrained in me to be a little bit sports mad, and I have a background and passion in sports coaching. And I see a real big correlation between what I do in my day job here with clients and what I do with my sports teams. Okay, and it's what it makes me super passionate. It's about helping teams or clients realize their true potential, whether that's financially or on the football field. It's making sure that people are aware of what they're capable of and pushing themselves to achieve the best version of themselves that they can be. So I guess enough about me. Why do we want to grow wealth? Okay, why should we prioritize that? What I like to say is wealth gives you options. Okay, I laughed and said earlier, it's not about the Rolexes and the private jets. Look, if that's what's going to make you happy, then that's what we need to solve for. But it's not common or not exclusive to those flashy items or a dollar value. Wealth's about options and flexibility. Having the options to retire how we want to retire, work how we want to work, as we get older, potentially helping out family members in the future, ticking off big travel bucket list items that have been there, but we don't think we're actually fully capable of. But we haven't actually really tested that out, have we? Have we given ourselves the best opportunity to achieve all the amazing things that we want to do in life? Wealth brings security. It's going to reduce stress when you know that you've got good safety nets in place to deal with life's unpredictable nature. Having buffers in these safety nets is super important to deal with any speed bumps that might come up along the way, but also if any opportunities present themselves in life that that you wish you could take advantage of if you just had that little bit more. If we can accumulate wealth earlier to make those opportunities a possibility, that can really help with the options that it creates. I like to say that it solves a problem, and use that word, use the word problem with inverted commas, because it's working out what we're aiming for and building up the finance ability to be able to do those things, whether that's being super ambitious and an amazing bucket list to achieve, choosing the areas that we want to work in as we get older, leaving a legacy for family, for future generations. It is getting harder and harder generation after generation to get ahead. So maybe we're wanting to give that leg up that we may or may not have received to put us into the position that we're in. A common misconception that I guess I hear all the time is wealth creation is only for the rich. Anyone can build wealth up. We might have to start small, but working through what the right structure is and what your income is allows for anybody to do the best of their ability. Okay, it's not just for the mega rich. That's one of the key things I want you to take out of this is working out your scenario. Doesn't matter what you might not have, working out how to make the most out of that. Another common thing is putting money into managed funds or property or investing in any sort of way. It's just another form of gambling. And that couldn't be further from the truth. Yes, there's risk and reward attached to that, but there's a lot more strategy and expertise that goes into it than potentially hoping for a random bunch of numbers to appear on a Thursday night, or a ball to bounce a particular way, or a horse to run super fast. It's not gambling like it is in those other areas, but it can be done wrong. Okay, so you need to understand the right strategies to be able to do it smartly. Okay, so you're not relying just on luck. Another really common one I hear is that you need a numbers background or a finance degree. Look, having the right advice and the right people in your corner beats having a solid background. I see some interesting situations with clients of mine that do have an accounting degree or an economist or have a numbers background behind them, where you might on paper think they should be smashing it out of the park, but they're not doing as well as they should be. One of the reasons for this could be because they're dealing with numbers and big numbers on a daily basis for clients or the company they work for. And by the time it comes to looking at their own situation, they're over it. They don't want to put the same level of effort into it. So if you don't have that numbers background, don't use that as I can't do it. I can't get ahead of people who have that in their back pocket, because sometimes it actually holds them back. And the last dot point on the screen there is super important, okay? It can take too much time, and we are all super time poor, but a really good strategy shouldn't be taking up too much of your time to grow your wealth, okay? If it is, it's unlikely you're going to be able to stick to it for the long run, okay? And it's consistency over time and being able to stick to these plans is what's going to make the biggest bang for your buck. And so making something over complex that you've got to put another 30 hours a week into isn't what I'd be recommending. Next, I'm going to talk here about the impact of leaving your money just sitting there in the bank. One common thing that people might do is have money just in a savings account, or even worse, an on-call account, earning that little bit or next to nothing of savings. Inflation's the silent theft of that savings pool. Okay, let's put a practical example to this. Think back a year or two ago, what you could have put in your trolley at any supermarket, not going to pick on any in particular, but what you might have been able to put into that trolley for $200. Think about those same items now. I bet you they're costing a lot more than $200. Okay, now if that money that $200 sat in a savings account, it might have grown to $210 with the interest compounding over that year or two, which is fantastic. But if that trolley is now costing $245 and you go to the till with 210, you're going to have to take items out of the trolley. Your buying power has gone backwards over time. Okay, so money sitting there just earning interest won't grow wealth. It's stagnating and actually going backwards because your buying power has reduced over time. So investing is the way to beat that stagnation or seeing your money go backwards. So what is a wealth plan? Look, I like to call it a roadmap to financial success. Okay, a wealth plan needs to understand the right mix of assets that you've got already in your starting point, but what you need to do to get that end game solved for. Understanding how long you have, understand that goal and timeline that you're working towards. Okay, that's an important part of building a wealth plan is the length of time you've got to solve for what you're trying to achieve. If you're taking on any new debt or if you've got existing debt, what are the strategies you've got to get out of that debt in the smartest possible way as quickly as possible? It's important to understand your financial habits. Okay, what's going to make you tick to stay consistently on the right path to achieve the success that the plan set out for? Because any plan is worth the piece of paper it's written on. It's sticking to it over a consistent period of time is what's actually really worth the most. Okay, any plan can tell you one thing, but if it's gone 6 weeks later, it wasn't worth it. Then the last dot point there is dealing with the hand that you've been dealt with. You know, once you've really maximized or understood your current position well, maximizing what you have, not just thinking, oh, it's for the wealthy or for somebody with a finance degree. Maximize your backyard first and control the controllables. So the starting point is super essential here. You know, any good map needs to understand where you're starting from. And I like to say sometimes the most boring stuff is really the most important piece here. Cash flow. Might bore you to brains, but more money in than money out is going to create options for you to grow wealth. Okay, all good financial plans rely on a solid cash flow plan. So your starting point, are there ways to maximize or increase the money in side of things? Could you be, you know, earning that little bit more? There's probably less levers to pull on that side of that formula. It's the money out where we can actually really control some more controllables. Are our debt structured effectively? Are we on track and sticking to our cash flow plan? Okay. The wrong types of debt, they're going to slow wealth creation massively. If we have short-term debts with high interest costs, we need to be focusing into that area first because the actual interest charges that we're paying can really outweigh any growth that the money that we're investing is putting in. If we have a mortgage, you know, we might be on a 20, 25, 30-year term. We need to understand a better way to do it. What's a more strategic way to pay that off quicker? And I've got a couple of slides on the next 2 slides here, a couple of graphs that show the impact of somebody paying off their mortgage 10 years sooner. Goals are super important, okay? That's what keeps you motivated. You need to be able to track how you're going against those, okay? And understanding your risk appetite and your money habits, super vital for being able to stay the course. As I said earlier, I'm going to show you these next 2 slides that have a visual impact of somebody getting mortgage free at 65 and somebody getting mortgage free at 55. Okay, I'm sort of a visual learner myself. So hopefully if you're like me, these next couple of slides will resonate with you. This person here goes through that example of them getting mortgage free at 65, retiring, and their nest egg is just KiwiSaver. As you see here on the screen, they've got really limited retirement options. Their money's going to run out in less than 5 years. So as that sort of shows on the screen, KiwiSaver alone is unlikely to work for us. Okay. For these people, they would have to have sort of some uncomfortable situations where they're relying on family members or having to work more than they would like to beyond 65. Now I'm going to compare that to somebody coming to us and getting mortgage free, say 10 years earlier. Okay. You'll see here in the dotted lines was the person on the previous slide. The hard lines is this other example. This person's getting mortgage free at 55. And then in green, you can see they're building their nest egg up. Okay. They've got an extra 10 years to invest. Why that's such an important thing to understand is for many people, that cash flow, our life expenses, our biggest cost is the roof over our head, paying it off, whether it's a mortgage or rent. So having that cost become zero 10 years earlier creates an abundance of options for this example. Okay, so they build their nest egg up, fantastic, to that top point in green. Then we've got a new orange and a new red scenario that I want to talk to you about next. The orange here shows, you know, if they just eat away at their nest egg from there, their money's still going to run out at age 80, still much better than 69 from the previous page. But having a bit of a strategy in place makes those funds stretch out even further. Because just because you're 65 doesn't mean you shouldn't be still investing and the money should just be, sitting in the bank and doing nothing and going backwards. Having a solid post-retirement wealth management strategy sees those funds and that nest egg grow out an extra 10 years. So you compare back a slide, running out of money before 70 to these examples here and having money stretch out an extra 20 plus years. It's a pretty awesome change that one controllable helps achieve, and that's getting mortgage free faster. Goal setting, look, as I've touched on a little bit on some previous slides, it's really important to keep us on course. Clarity is key to building our wealth. You need to know what you're aiming for, how long you've got to achieve it, and what level of risks you're comfortable with. That's that motivation that's going to excite you and challenge you to stay engaged over time. These aren't get rich quick style scenarios to grow wealth. These do need to keep you motivated over the long journey. Next off here, we've got a few of those money tendencies. If you have attended any of our Enable Me webinars before, you may have seen these stuff on some slides earlier. If you haven't, just quickly touch on them. There's no right or wrong money personality. We're all individuals, aren't we? Okay, whether you're a shopper, a saver, or a plotter, it doesn't actually matter. You just need your plan to understand you, because what your money personality is, it's impacting on your financial decisions every single day, multiple times a day. So a plan needs to understand you really well. It can't be a cookie cutter approach. Can't be just a link you read off an article that Stuff or the NZ Herald has said that they've never met you. Okay, your plan needs to understand you. Same goes with your risk tolerance. Whether you're a safety warden, a dreamer, or an adventurer, there's no right or wrong personality trait there, but how your plan works with you is super important. You need that balance. If you are an adventurer and you're willing to take on risk, you could lose it all. Okay, so it's important you're understanding the risks involved with that and having experts on your side to de-risk your situation. For someone that's more safety conscious, understanding the risk of doing nothing and the cost of doing nothing is super important for them, because the opportunity cost is, whilst not coming out of your hip pocket, with a lost amount of money, there could be a gap that you're not solving for by just sitting around doing nothing, having that money sit in savings, going backwards against inflation, like I explained earlier. So it's really important you've got an awareness of your habits. Okay, these will help shape smarter decisions and strategies going forward. If you're a couple, you may have a good mix between different money personalities and approach to risk. So understanding where you both come from and building a plan that talks to both of you is very, very important. Okay, money is one of the most common things that causes arguments between couples, and it can come from just that misalignment on personalities, which is neither being right or wrong, but not knowing where to and how both of you can be listened to. The most important thing is, having a strategy in place that understands you and is tailored for your situation, and being consistently able to stick to a plan. What are some of the different wealth options that are out there? I've got a number of them here on the screen, and it may feel overwhelming when you see them all out there. There's many different ways to invest, but not all suit your situation in life, your life stage, your risk personality. A lot of them will have different entry barriers. Some require a high cost and more capital to start than others. Others need more time. Okay, so you need to understand the different barriers that each of these present themselves. Understand the risk and reward. Some, like shares or digital currencies or starting a business, are higher risk and more volatile, while others, like bonds or savings or cash, offer lower risk but a lot lower returns. So understanding what the right risk and reward and right mix is super important for you. And the key here is aligning your options with your financial situation and your goals. Not every option is going to be right for everyone at every single stage. What might be right for you in 10 years' time is not right for you right now. Okay, and what's right for Barry across the road is not likely right for you. Again, because I'm quite a visual person here, I'll just show you an example of what balancing risk and reward looks like. Okay, as you see down the bottom, low risk, low return on the cash side of things, and working our way up with managed funds, property, shares, and business. Risk and reward tend to go hand in hand. Safer options are likely to yield lower returns. So you've got to understand what you need it for. Okay, understand if you've got a bigger savings gap, you might need to take on some slightly more risky options along the way to solve for those gaps. But a key thing I'd like to stress here is a well-balanced plan balances the risk and reward to your financial needs. KiwiSaver, hear this commonly, is it worth it? In short, yes. Okay, it's a great foundation, but it's not a complete retirement plan. Why is it great to have? Because there's employer and government contributions. If you're self-employed, make sure you're putting the minimum amount in to get that government contribution. It's money that's just left on the table if you're not doing it, okay? One thing I would say is make sure it's regularly reviewed and working as hard as possible for you in the background. Next off, I'm just going to talk about a couple of those asset classes and some pros and cons for each of those. Term deposits, I feel like we've talked about a little bit already here. It's another form of savings. I've maybe talked them down a little bit. So I'm just going to say when they can work well for you is if you know in the next 6, 9, 3 months, whatever it might be, in 12 months, you've got a specific need for that money, you can't afford any risk. You might have to forego some gain to know that the 50K you need in a year's time is worth, that you've got right now that you need in a year's time is at least 50K. That's when a term deposit could be right for you. Managed funds. Just talk to this slide for a little bit here, and you'll see on the screen here, one of the big advantages I see with managed funds is they offer good flexibility for different risk levels. You can see the returns for the different risk levels there: conservative, balanced, growth, and aggressive. One of the great things with managed funds is not all your eggs need to be in any particular basket there. Depending on your stage in life and when you need the funds, they need to be invested accordingly. Okay, so it's got great flexibility there. Managed funds provide a great form of diversification when investing in the share market. Okay, it's not stock picking. So your money's spread across multiple investments, which reduces your risk if you think back a couple of slides how high up shares were compared to managed funds. I guess one of the drawbacks we've got here is around fees. What I would say to that is, yes, these fees can eat into your returns. So it's important not just to look at the gross return from any provider, but understand the net return. Okay, and that's gross returns minus any fees. Understand that and how they compare against each other, because you can guarantee somebody's going to charge their fee. They can't guarantee the return they're going to get in the future. The other drawback we've got on the screen is about the choice being overwhelming, because there's a lot out there. I guess I would just counter that to say it's not always a drawback. If you're hungry and looking to go out for dinner and you've got a lot of choice, if you rush and make an uninformed decision, you could be underwhelmed. But if you get some recommendations and you work through the process, you should hopefully be getting a nice meal at the end of it. Managed funds is the same. Okay, there's a lot out there. You're not going to starve, are you, if you've got a lot of choices for where to go for dinner? Do the same thing if you are investing in managed funds. Just because there's a lot out there, don't avoid it, okay, because it can be a useful tool. The final one I'll talk about is property. And, it's such a common barbecue topic around is it still a great investment tool? And some of the key benefits here are it is, rental income, providing cash flow. One of the other big ones is people can see it. It's tangible. I see this can be a pro and a con, okay? Because you can see it, you might be more willing to take that step, but you might also make irrational, emotional decisions along the way. Key advantage is that you can use leverage, which I'll talk a little bit about what leverage means and the power of it on the next slide. The drawback is around if you need to turn the asset into cash, the time it takes to sell a property is a lot longer than getting funds out of a savings account or managed funds. And lastly, it's not all properties are a good investment property. Some may not grow in value. Some may not have a high rental demand. So having a right strategy in place is super important to making sure you're using this asset class effectively. And as it says on the screen here, if you do have a retirement gap of over 300,000, you'll likely need that power of leverage to close that gap. And what this power of leverage and the magic of it is explained here again visually on the screen for you. Is let's take this example. This client, fantastic. They've got $160,000 to invest. On the left, they put it into a managed fund with a growth rate, as we saw earlier, of 7.5% from a few slides back. Fantastic. Now they get a $12,000 return on their $160,000. On the right, they put $160,000 into a property with a 20% deposit, and they get a 6% capital growth, which is the 30-year average. Okay, I'd like to think me and my clients will outperform that average, but let's just take the average there. 6% grows though off an asset value of $800,000. It makes $48,000, 4 times the amount on the left. Now, it's not because property is grown by more as a percentage, it's grown by less, but it's because the asset value on the right is 800,000 compared to the asset value on the left being 160,000. Okay, that's the power of leverage. Important thing I want to stress here is it's not the 90s or the early 2000s when just any old property cuts the mustard and makes money over time. It is harder, okay, but with a tailored strategy, you can still make this proven asset class and this beauty of leverage work for you. The best approach for you really depends on your own personal circumstances at the end of the day. As I keep alluding to, no one size fits all approach. No article is going to solve your best financial strategy for you. The guy across the road or mum and dad, what it is for them is going to be different for you. Needs to understand your time frame, your goals, your risk appetite, and your financial flexibility. As Warren Buffett's quote says there at the bottom of the screen, you know, it's long-term commitment beats trying to time the market. You got to stay invested in yourself and your plan. That's the key to grow wealth over time. Some really common mistakes that I see before we wrap things up, okay, here on the screen, lack of diversification, that can leave you overexposed, having all your eggs in one basket. The way to de-risk that's having a mix of investments to balance the risks and returns. Not prioritizing short-term debt. You know, you might have great intentions and start investing, but you've got some real high interest debts that are charging you 10, 12, 15% interest. As you saw earlier, if we're getting 6 or 7% returns and you're paying that amount of interest on short-term debts, we've got to actually focus in there first, okay? The other really common one, which alludes back to the Warren Buffett quote, is waiting too long to start. Might be a silent cost here because time in the market's the key to compounding growth and wealth over time. And lastly, and not just always linked to property, it could be certain other asset classes too, is making emotional decisions. What you've heard might not have worked for somebody else who might not have had a solid plan behind them, might scar you from the right thing that you should be doing with money. Or when it comes to property, you know, because it's tangible, people often lead to buying familiar or likable properties rather than an investment property, okay, and they don't maximize their return. So some key takeaways before we get to some Q&A at the end here. What I'd like to say, and I've got that consider the problem you're trying to achieve in inverted commas there, is start with that goal. What are you trying to achieve? What is the problem itself, or what are you trying to make? What is the timeline you're working towards? Understand the commitment that's needed to achieve those goals. Understand the time is key. Okay, delaying actions will limit your options later in life. Making sure you've got a clear purpose to work towards. And understanding what your risk preferences are. Align your investment with your personal comfort levels, but understand what your needs are, okay, because your personal comfort levels might leave you short in the long run. And lastly, I'd say, and I'll talk about this in some detail on the next slide too, is understand that expert advice can save time and money. Okay, time, well, there's a lot to take in. There's a lot of information in this space about growing wealth. Okay, so working with someone to give you guidance and clarity can help you take action sooner. And as we go back to that Warren Buffett quote, it's time in the market that makes the compounding impact. And money. Making good choices can help avoid those common mistakes that could silently cost hundreds of thousands of dollars in the background. Okay. So on that note, as I sort of alluded to earlier, these are a 30-minute quick chat really high level informational. If you'd like to actually put some of this knowledge, knowledge is power, but put some action behind it to build your wealth, I would strongly recommend to take up an offer to book in and have a session either with myself or one of our amazing team, okay, and get to know what it is that you're trying to achieve and building a plan for you to achieve it. So I've got the QR code and the enable.me financial freedom Justin link on the screen there. Our initial consultations are normally $400. You can get that for $149 if you book today or tonight. Okay. If after today, we still got a great offer on the screen for that to be $249. If you're ready to take action, get to know what it is you're trying to achieve and how you can achieve it, I would strongly recommend to take up that option. Okay. Just going to throw to my producer, Olivia, who's been collating those Q&A, and I'll try to take maybe 2 questions. I know we're all pressed for time. I'll go a little bit over. If anyone needs to drop off, obviously, you'll be getting a recording sent out. But yeah, Olivia?
Thanks, Justin. The first question is it wise to start building wealth while still paying off debt?
Yeah, look, depends on the type of debt. As I sort of talked back a couple of slides ago, if it's really high interest debt, we really need to build safety nets so you don't get back into the trap of falling for that and paying that off as quickly as possible, because the interest that you're paying on some of those debts can erode or be a lot more than any investment gains you're making.
Great, thank you. Next question is, we are mortgage free. How do we know if we are ready to invest in a rental property?
Yeah, look, I think fantastic. First off, being mortgage free, you're in a really, really great position. You've got equity then in your home to be able to. The bank will be the one who determines that. Okay, they'll be assessing your income and expenses to understand the level of borrowing that they'll be willing to lend to you. So, yeah, I'd be having a chat, whether it's with someone like ourselves or another financial advisor, a mortgage broker, or the bank, to understand what your lending capability is.
Great, thank you. And last question, how do I figure out how much wealth I need to accumulate before I retire?
Yeah, great question. And I think probably the stuff, and NZ Herald will probably run these articles 3 or 4 times a year, I'd say, is understand your own unique situation. Don't just go off averages and articles that have never met you before. Okay, understand what it is you're trying to achieve and the retirement that you want and the legacy you might want to leave behind for family, etc. So there's no black and white answer to this stuff until you actually talk to a professional and understand what it is that you're looking to achieve. Cool. All right, look, that's a wrap. I know it's 30 minutes goes quite quickly. So I'd just like to say thanks for taking a moment to understand this information and think about your financial future. As we said earlier, if you'd like some more tailored solutions, and hopefully our paths will cross again and book in a consultation. And yeah, thanks for your time and enjoy the rest of your day. Thank you.